been looking forward to the Arm IPO since it was acquired by SoftBank in 2016. But in the end, we decided that we really were too worried about the corporate governance with SoftBank still controlling the company, with a questionable record for asset allocation. So we wanted to basically watch from the sidelines for a bit to see how the company operates as an independent business.
So the price popped 25%, and what I thought was remarkable is if you look at it from a valuation perspective, that takes the price to earnings to around 170. NVIDIA, which is the closest company, I guess, that we can compare it to in terms of how much hype and sentiment there is around it, trades at 109 times earnings. Are these valuations actually sustainable? And if they're not, what does it mean for the rest of the tech sector?
Well, the valuations you're referring to are generally backward-looking, so they're taking today's price and comparing it to last year's earnings or historic year's earnings. And the point, in particular with NVIDIA, is that the forward earnings are far, far higher than the earnings for the previous period. And if you look at NVIDIA on a forward multiple of earnings, it's actually, by its own recent record, the last 3 to 5 years, pretty cheap. So it's been trading in the 40s, low 40s over the last few years, and the moment it's in the low 30s, not because the stock price has gone down, but simply because the earnings have been going up, or expectations of earnings have been going up so fast. That wouldn't be the case for Arm. I don't think we'll have that explosive growth of earnings for Arm that NVIDIA is seeing at the moment. But you definitely got to look at forward multiples rather than backwards. I thought probably a better comp for Arm would be Cadence or Synopsys, probably.
Well, William, just taking that a little bit further, how far out do we have to go in terms of those earnings expectations for Arm's valuation to look more palatable?
I suspect a little way, because at the moment, in some ways, it's not a bad time to be buying Arm because all is not going perfectly for it. The smartphone market is still its biggest market, and that really has been stagnant for a while. They've been eking out earnings growth by increasing royalty rates and adding, additional cores for each device sold, in effect. But that's a pretty dull market to be your base market, and then all the more exciting stuff's being added onto the side of it. So I think you'd have to go out quite a few years before you saw a huge increase in earnings for Arm, which would then bring your forward multiple down a bit. So I think it probably does look quite expensive. But the problem with technology companies is that absolute valuation is almost unknowable until after the event, because success is so incredibly profitable. The returns from success are enormous in technology, as NVIDIA is showing at the moment. So I don't get too attached to absolute valuation.
William, we've seen the big bump in Arm so far on day one and pre-market now as well. Just given those headwinds around the slowdown in the smartphone market, perhaps a slower transition to some of these new areas like data centers and also automotive, do you think this share price can be maintained for the coming 12 months or so?
Well, I must admit, as I said, we're sort of sitting on the sidelines and waiting to find out. So I'm definitely not saying that this is the absolute right time to invest it, or I'd be invested myself. There's quite a lot of uncertainty here. There are various issues with the Chinese portion of the business, which effectively is being written down to zero, but it's still there. Exposure to China in general. There's a lawsuit going on with Qualcomm. There are always lawsuits going on for these companies, but this is quite an awkward one about royalty rates with this, I think, its biggest customer, also the second biggest customer. And on top of that, you've got this issue of corporate governance. How good are the decisions going to be made? This used to be an incredibly profitable company. While it's been with SoftBank, it's become a reasonably profitable company. That's not a good direction of change, in my view. There's also a competitor product, RISC-V, out there, which is essentially free, but it doesn't have the ecosystem. So you don't pay much up front, but you have to do a lot of work building the stuff that Arm would sell you. So there's question marks over this company, but then there always are businesses. So I really don't know whether it'll go up or down from here. The semiconductor industry as a whole, I think, is in a very, very strong position. But this stock has just come to market. It's been out for a while. A lot has changed. And I think it's going to take a little while for the market to work out what value it should be trading at.